Good morning, everybody. Welcome to the Flow Show. New week begins. A bit busy on the data front, but we got US holiday today, so we might be getting an easy Monday to start us off for the week. I hope you're doing well. Hello to Tony there, and just for any other people who may watch us through other sources, YouTube and the like, we don't watch everywhere that we're broadcasting to for questions and stuff. It's enough to be getting on with trying to get Zoom to work most times. So we only monitor the questions and really answer the questions we see here on Zoom. It's just the easiest place to do that. So if you are watching on YouTube and you do have a question, we're unfortunately unlikely to see that. Unless, Kay, you want to become our YouTube correspondent and monitor questions over there?
A good morning and have a good week will do.
Morning, mate. Yeah, so
no, I've got enough stuff open, you know.
Yeah, we can't have eyes everywhere. Got enough eyes on markets and whatnot, and so on. Right, well, anyway, let's get cracking. The PBOC, perhaps surprisingly, kept its one-year MLF rate unchanged at 2.5%. Pretty much all market participants were expecting to cut it by 10 pips to 2.4%. So a bit of a surprise move there, keeping rates unchanged. Maybe they don't want to spark a bit of panic, let everyone know that they're, really going hammer and tong on the easing. They're going to take a slow and steady approach and not conform to what the market expects. Who knows? But that rate not being changed just yet, despite a lot of people expecting them to be cutting in rates again this year. Over on the data front, we had some machine tool orders out of Japan, which wasn't overly great, minus 9.9 year on year. Not as bad as last month's minus 13.6, but still showing that there's a bit of manufacturing weakness in Japan, as we've seen elsewhere too. We did have a former finance minister official in Japanese press. This man has been called Mr. JGB because he was one of the guys, the top guys at the Ministry of Finance, who oversaw the changes to how they operate the bond markets a while back. So, as I say, Mr. JGB seen as a bit of an important ex-official. He says Japanese long-term yields won't climb much beyond 1%, even if the Bank of Japan revises its yield curve control program or raises its short-term policy rate. The bond market will largely take in its stride any normalization steps by the central bank this year. Probably got a bit of a case, would you say, K-Man? We know it's all going to be a slow progress.
Well, of course, and we've already heard and read from the big market interveners that they don't expect yields to really ramp higher too much, as we've seen already. The Japanese investors, when yields were climbing, were pretty happy to go to market to do a bit of shopping, and we weren't even above 1%, and in the longer end, not even above 1.5%. So yeah, it's just what we've been saying for months now. It's probably going to be a slow and if not a very limited process. It could all be, assuming that they start beginning of the fiscal year. I think by the end of the year it may all be over. Take yields positive to an extra couple or three perhaps 25 BP hikes, and that's it. I wouldn't expect Japan to come with anything bigger than 25 BPs anyway.
Yeah, would they even go that? Maybe they're just going 10 pip increments to start things off, and
that would be a big blow for the yen, I think. If they do only I'd say if you look at it from how yen has been reacting, take away the volatility, but just where we are on dollar yen is one thing, but then you also look at the yen crosses. If they would do only 10 BPs increments, I'm I fear that the yen is on its way for fresh lows then.
Yeah, I mean, I don't think. Well, you might correct me. I don't think we've got much expectation past when they just did negative rates. You know, as I say, I might have missed stuff, but I don't know if I've seen people saying, you know, they expect BOJ rates to be X, Y, Z by the end of the year. Everyone just seems to be concentrating on, are they going to end negative rates, and then worry about what they do there on after.
Well, there has been some a few discussions here and there, and there's anything between 2 and 3. Well, let's say between 0.5% and 0.75%. I don't think that the overnight rates will be taken to 1% even. But the longer end may take may gradually move higher up to perhaps anywhere between 1 and 1.5%. But that's where we will have to see what kind of increments they are going to do, because assuming that you then see US rates anywhere between 3 and 4%, or 3.5 to 4% or so, and ECB somewhere the same, you will still be looking at several percentage points of differentials, right?
Do you think we're going to get to a situation like we do with the other central banks, where we've got to at the end of negative rates, and then we're going to, you know, every time there's a data point, you know, money markets or bond markets or futures market price X amount of hikes by this date, that date? That's the sort of thing, I mean, we don't get from Japan like we do the other banks at the moment.
No, but we see it in just a bit of the price action on especially the 10-year JGBs, right? And
Yeah.
Okay, there's started to be a bit of interest on the 7 years as well, if I read that correctly, the past few months. No, but we have seen this kind of speculation ahead of any Bank of Japan meeting, and I reckon we are going to be just in similar situations until they really tell us that they will go with more hikes. You know, we've been in this preparation time for a year now, since Ueda took the helm of the Bank of Japan. The small changes, the incremental wording change, the few how shall I say, messages sent to the market. So and then we see the reaction on and post the meetings, and this could be just the playbook for the whole of the year, in various degrees of volatility. And you know, really, if they really take us, they should really take it into positive territory, because of the complaints that they had from all the regional banks. And don't forget that the market is probably right in saying that the earthquake that we had on the 1st of January has delayed some of the process, not in actual facts, but in the wording, perhaps, giving that extra bit of time to the government to finance their extra 500 billion yen or so. But in actual facts, if you would just extend the timeline just a little bit, it hasn't changed much. So I would be surprised if they stopped just at taking the yields out of negative territory and put it at 0.25%. They have this window of opportunity, which is now closing very fast, because the rest of the central banks will cut rates this year. So it's really, we have been saying that for 2 years now. Corona should have already stopped everything, but it's really the window of opportunity to take Japanese yields into positive territory, you know, and really positive territory is now or never. And I'm afraid that if they don't do it really at the start of the fiscal year, and then in the next 2-3 meetings, it's going to be they're going to be trapped again. But notwithstanding that, I do think that they will take it more than just put them at zero or abandon YCC. They should do a bit more. And then that's where you should have the reaction in the yen initially. And then we will see how hard they are willing to press on the pedals to on the accelerator. But if they only would do 10 BPs increments, then I really fear for the yen, you know.
Yeah, no, I agree with that. I think, yeah, you're right, and we've been saying it for a while now. I think what we're gonna get is that confirmation reaction in yen, if and when they decide or announce, yeah, we're ending negative rates. There's going to be a confirmation move, and then the next part of the trade kicks in, which is what they do thereafter, and how long it's going to take them to do that.
Yeah, we've already had the actual market reactions, right?
Yeah,
Because they have not moved rates. They have moved the YCC. They scaled back on the fixed scheduled JGB buying, but we did see what the market is doing. You speculate ahead, then you do an extra big figure or two, depending on the reaction, and then you go the other way around again because the market still is in that scenario where if you're long yen, you better be right relatively quickly, and because otherwise the funding is biting. The funding will be less because the other banks the other central banks will cut, but the actual playbook may be very similar of what we've seen already, unless they really go. I think 25 BPs may already change the picture a bit if they signal that there are several 25 BPs in the pipe. So. But again, I think the big moves, even though we have seen big moves, we have seen 4 or 5 big figures already from 140 below 141 to 146 on the dollar yen. But to get a lasting move, they will have to signal that they are willing to go for at least a couple, if not more, 25 BP hikes once they
yeah.
arrive.
We need to see that. We need to see that it's a proper hike path, not
Yeah,
just
exactly.
a get out of negative and stop there for another 2 years. But yeah, anyway, interesting times ahead. As you say, if you've been waiting long enough for it, we'll probably get there eventually.
Yeah, I think anywhere. We've got perhaps 2 months or so, 1.5, 2 months to wait before the real market speculation sets in, and it could be like very much buy the rumor, sell the fact case as well.
Yeah.
Yeah, but I think really Q2 this year is where a lot is going to happen, whether it is on the Bank of Japan, and then I'm reading also what Ali is already typing there about the Fed expectations. I think Q2 this year is going to be a massive quarter for markets.
Yeah, very much so. I'll go so far as say this first quarter as well is going to be busy enough because everyone's circling March on the calendars for everyone's rate cuts. So we have to see whether that's going to happen or that's going to cause a bit of a big reprice as well if no one cuts in March. But yeah, we're only in January still, so plenty of time for that water to go under the bridge. On the inflation front, Sweden seeing some softer numbers coming through in inflation as well, pretty much in all their measures, year-on-year measures. There was a bit of an uptick in some of the monthly numbers, but the year-on-year numbers coming down pretty significantly. This is their CPIF, which includes interest rates as well, fixed interest rate, I should say, 2.3 from 3.6, although not falling as much as expected. Headline CPI coming in, missing expectations by a pip, but still a significant drop on there. So that's good news for the Riksbank, and likely to keep them on hold, and no more hikes from them particularly. ECB's Lane has been out over the weekend and was out on Friday as well, saying that rate cuts are not a topic for the near term. However, he has sort of in a roundabout way put June on the map, saying that by June they will have enough key wage data that they need to start before they start thinking about rate cuts. So wage data, amongst other things, is important for the ECB. So he's kicking the can through the early part of the year anyway, and saying that they'll have Q2 data for wages by June, and that's when they may be able to make an more informed decision about rate cuts. So a little bit of a pushback on the March pricing there by Lane. We had some numbers out as well this morning. Industrial production numbers coming in as expected, down 0.3, bit worse year on year. So pretty much echoing what we've seen previously. No real change to the trend there. Friday, going back to the US data that we got, PPI data coming out, which went a bit the other way to what we got from the CPI numbers. Most of the numbers, it was in and out. The core number came down. The PPI headline missed year on year, although it was up on last month, a revision there, but still missed expectations there. So a little bit the other way to what we saw from the CPI. A bit more mooching around by the market again on Friday, but largely back to where it started before. We're seeing that again, what Ali's talking about. What's the dollar going to do? Is it going to be strong? Is it going to be a safe haven? Is it going to be weak? Pricing Fed hikes expectations, cut expectations. It's all mixed signals. Yes, very much. It's all mixed signals. For all the data we saw last week, pretty much most of the majors are exactly where they were or close in ranges that we saw all last week. So we haven't managed to do a lot of breaking. And that's pretty significant for trading, because you need to know what seas you're going to be sailing in. If they're calm and quiet seas, don't expect to get any huge moves in anything, or for those moves to last. Now, a bit of a change from Fed's Bostic, who was one of the early proponents of going on pause and saying that the Fed had done enough. He says he expects to see much slower progress on inflation moving forward, and some risks that inflation may stall out altogether, and said it would be a bad outcome if we started to ease and inflation started to rise up and down like a seesaw, saying that he thought that rates would need to remain on hold until after the summer. So it's for Bostic, you could probably call that mildly hawkish. As I say, he was one of the big proponents in the Fed going on pause and saying they've done enough on rates. I think, if I recall correctly, he expects 2 rate cuts this year. So he's not one of the most dovish in terms of on the cut side of the trade. But he is warning now in that interview about the possibility of sticky inflation and having to keep rates higher for longer. So a lot of Fed members coming round to that way of thinking that maybe the market is getting a bit out its pram, pushing for early cuts, and there's more work to do. We'll obviously get that reinforced from further Fed members, and then Powell himself when we get to the next FOMC. Bank earnings all started dropping on Friday. There were some hits, there were some misses. JP Morgan was a bit of a miss. Citi CO called Q4 very disappointing. I didn't really see any horrendous numbers, nothing that would indicate that there's any big issues there. Yes, some revenues were down, but when you're making revenues of 18 billion and it comes in at 17.8 billion, it's hardly anything to start panicking about. When you talk those sorts of numbers, if they start coming in with minus numbers, then you've got to worry about it. So largely, we sailed through that early day of bank earnings. S&P really just jumped up and down with each number that dropped. So far, so good, I would say, for the earnings. On the earnings front, we do have more earnings today, and it's obviously a busy month for earnings for those Q4 numbers coming through. Did you see anything in the earnings that got you worried, Kay?
Yeah, you say a bit of a miss, but it's still a record year for JP Morgan, and they actually made I think a fair percentage of all the major banks' profits. So the thing is also that the market is always expecting earnings to be so-so. but then is forced to admit that they are holding up. So there hasn't been that. That's I think the theme that I saw is that no dramas apart from City, but City seems to be now in these years of problems or issues left, right, and center. It's a bit worrying. They also said that they would cut 20,000 jobs. I mean, this is
Yeah.
that's a large number by any measure. Yeah, they seem to have problems to get their act together. But apart from them, I haven't seen anything dramatic in those in any of the data really. Yeah, and then Bostik is a bit of a he tends to switch a little bit between the mildly dovish and mildly hawkish side, and now he's back on the on what we may call the more hawkish side. And it seems that him and Lane pretty much cancelled each other out between the Fed and the ECB. But it had as an effect that I mean, it seems like euro crosses are doing okay, and the dollar is doing okay this morning on a
Yeah.
what we could call a transition day. We still got a few moves there on our hands.
Yeah, exactly. I mean, the last thing I wanted to say about the bank earning stuff was one of the things that jumped out was that a lot of banks, or a few banks, are raising their provision for credit losses, which is likely a natural reaction to higher rates. The potential for bad debts to increase is natural. So, hearing of banks seeing, higher debt levels or defaults or things like that isn't, of course, it's a bad thing, but it depends on how bad a thing it becomes. There's always going to be that sort of thing happening when you raise rates, particularly if you raise them as high and hard as these central banks have. But as long as it doesn't become a financial stability risk or a huge profit risk to banks, then it just passes by as part of natural business. But that was something, particularly JP Morgan, in the JP Morgan numbers, that they made that distinction that the provision for credit losses was up. In the geopolitics, there's more shipping firms avoiding the Red Sea for whatever's going on over there, all the stuff going on there. Qatar has also said it's pausing LNG, or has paused LNG shipments via the Red Sea. They've not stopped production, but they're not going to be sailing via the Red Sea, which could impact some European countries, obviously looking elsewhere for their gas supplies to get away from the Russia stuff. So that could impact in short term if it means obviously greater delays in sending all those ships around Africa rather than through the Red Sea, particularly as winter is in full steam at the moment. Last thing, just want to bring it up. We had all this Bitcoin stuff going on, this ETF stuff. There's been a lot of, I call it shock jockeying, probably the easiest thing to call it. People calling it a complete failure of all these ETFs, that they haven't seen the inflows that was expected. That is in part reason, I think, the Wall Street Journal highlighted it this morning, the story that UBS is letting customers trade Bitcoin ETFs. So I think what's that story highlighted is that not everyone is allowing your everyday investors yet to access these ETFs. Just because they're open doesn't mean that the doors are open to, mum and pop investors at the moment. There's probably a lot of regulatory stuff going on behind the scenes to make sure that everyday customers can trade these without any problems. So everyone that's calling these a failure 2 days after it's happening, yet Vanguard's one of those not letting people get into them. So 2 days after this happening, everyone's calling it a failure. I think it's a case of see what happens. Come and see what happens in 6 months or a year before deciding that this is all a failure. I'm only looking at it from just from a matter of viewing interest. I haven't got any skin in the game, but lots of talk about this. I've got a interest with the popcorn in my hands to see what happens. But yeah, just a few shock jocks claiming that it's been a complete failure at the first instance on the launch. Okay, you got anything you want to bring us that you've seen over the weekend or this morning?
Well, but there's one thing that Australian inflation data came off sharply. Did you already talk about it? It's a
No,
number that wasn't really taken down on all of the calendars, but the US inflation dropped quite a bit, from 4.9 to 4.3%.
Oh, that was last week.
Was it last week? Okay, but anyway, I mean, there's something going on these antipodians. The Kiwi getting hit even harder than the Aussie, and I must say, this is something that I did not see any reason. But then, I think it's perhaps a case of putting Bostik and Lane together, taking those euro crosses perhaps a bit higher. Also, commodities coming up a little bit, although copper is holding where it is holding the fort. But yeah, I mean, there's been some marked weakness in the Australian and especially in the Kiwi dollar this morning. I do think it's perhaps people trying to buy those dips, and on a transition day like we have today, where there shouldn't be too much happening, perhaps just getting out of positions and waiting what the rest of the week will bring. The one thing that I would like to say, but then we should be looking at prices, is that yield curves are steepening a little bit, and that may indicate that people are not looking at too much, or need to reprice a bit of the recessionary feelings again, and that is usually a bit positive dollar as well. But for the rest, no, I have nothing really new. The Taiwanese elections gave the win to the incumbent party candidate, but they lost their majority in what they call it over there, the diet, or the where is it? Let me try to refine it, how they call it over there. Yeah, but anyway, I mean, so the US delegation is already apparently there. We have not heard too much from China yet, but I think this is one of the under the surface bubbling geopolitical stress that could still be popping up later this week. So that's still one that we need to keep an eye on, right?
Yeah, exactly. I'm still expecting. I haven't seen anything too strong. I've seen China moaning at the US for them congratulating the leader in Taiwan, but nothing stronger than that at the moment. It's probably in the pipeline coming along at some point. China just gonna reiterate its stance on bringing Taiwan into the fold, but we'll wait and see what happens with that. Nauru has severed ties with Taiwan on the back of that election. They now no longer recognise Taiwan as an independent state. So they're severing all diplomatic ties on Nauru. I think that Nauru's about as big as the Isle of Wight over here. So in one of the Pacific islands, they're doing a lot with China at the moment, so that's the reason why they've severed ties. But that's as strong as it's got for the moment. Right, let's have a look at what's coming up this week before we get into the prices. Not a lot today. Keep an eye on Canada, that business outlook survey later today. That can sometimes influence the CAD if it's a strong or weak report survey there. As mentioned, it's quite a big week for the UK this week. We've got a ton of data coming out, pretty much covering everything. We've got jobs tomorrow, which is still affected by this ONS messing around with how they're counting the numbers. Obviously, the seaweed's dried up and they've had to get some new stuff. That or the tea leaves have run out, something like that. So it's we'll take it for what it is, that labour market report tomorrow. We also get Canadian CPI, so that's going to obviously play into Bank of Canada thinking. And then we start to get the first manufacturing numbers of January from the Empire State Manufacturing, which has been a bit hit and miss of late, a bit volatile of late, so not much of a leader for the rest. Wednesday, we get a ton of China data, GDP numbers, retail sales, industrial production. So that'll be looked at closely by me in particular. I'm not going to get up for it, but I'll see what it does next morning. UK CPI, PPI numbers. So that's, again, going to be pretty important for the BOE and rate expectations. This Eurozone number is the final number, so not the flash number, so shouldn't be too much of a variation in that. US retail sales, that will give us another indication of what's going on with the consumer, and no doubt get rate expectations running around as well. Then we start to kick off some of the housing data as well. Thursday, Aussie jobs, that's one for you Aussie dollar traders, Antipodean traders, keep an eye on. Then we get more housing data, Philly Fed manufacturing, the second number of the new month, and Japan CPI as well, which again, ahead of the next BOJ meeting, 23rd of Jan, is going to be one to keep an eye on as well. Friday, retail sales from the UK, could be another good number from the UK. I was expecting that maybe December might be a bit wishy-washy compared to the strong November, but by and large, it looks like consumers switch their spending from Christmas presents to food shopping. So I expect that to be to come to prominence perhaps in those numbers.
We're pretty quiet for a while.
And the Canadian retail sales later on, and the Michigan number coming out there. I think that's the flash number for January. I can't recall seeing the other one. But yeah, that ends the week on Friday. And then from next week, we get stuck into all the central banks starting to roll in once more. Anything on there that you're sticking a circle around, Kay?
Yeah, I think the UK data, it could be the week where sterling picks a side. That is firmly on my radar, the combination of all those data. And especially, I think the two latter ones, right? The CPI, PPI, and then on Friday, the retail sales. The labor market report is supposed to be important, but then as we've seen, moves have been, how shall I say, rarely more than an hour or two algo moves, and then sterling has sort of settled down because the labor market, I mean, everywhere is still doing relatively okay. So of course, if it's a bad number, it will hit the sterling. But if it's a better number, it could be only a temporary little uptick for the sterling, and then waiting for the CPI. That is going to be, the sterling is one of the currencies that I'm going to keep firmly on my radar this week. And then yeah, obviously a couple of US data, especially the retail sales probably.
Yeah.
And then yeah, and as you say, the empire is a number which has been very volatile. On the other hand, I see that it has printed bigger negatives than the positives that came out over the past 6 months or so. So that's still in line with what's happening on the behind the numbers, that a lot of people in the market are saying, yeah, but the US labor market is not as healthy as the NFP data may show. So perhaps the market will take that as a bit of a guide to start trading dollars this week. Yeah, that's about it. I think it's, yeah, a good UK week to keep an eye on, I think.
Yeah, as you say, it could be a bit of a decider. Could finally kick us out this 200 odd pip range we've been mooching around in forever.
Yeah,
but yeah,
yeah.
I was going to say that labour market report. Yeah, it's a bit flaky because whatever the ONS are fucking up with it. But also, it's not like it's a bit like the GDP. You know, 1 month it's up, 1 month it's down. It's not really showing any big, huge trends like we've got. You know, it's not showing a 5-year bull market like we're seeing in US jobs or anything like that. So yeah, it can be a bit up and down. And when it's down, the world is ending. When it's up, the world's not ending. It's one of those numbers. So yeah, take it for what it is. Yeah, sorry, mate.
Yeah, and then the last thing, of course, this week is Davos. It's really kicking off tomorrow, I think. But there's every news outlet has speakers, so expect headlines to hit non-stop from. Well, it's actually already started, right?
Yeah.
With a couple of speakers, so expect headlines to drop every hour. And
I might make you a special WF correspondent, Kate.
well, yeah. This is this kind of this kind of forum where I would love to be a golf player and just go out playing golf for the rest of the week. Would it only be for that reason? But no, the one that I picked up is Lagarde is actually going to speak 3 days in a row from Wednesday to Friday. So
I think she spoke 4 days in a row last year, or the last one. So yeah, that's a bit of a win.
yeah. So I hopefully she will say what she has to say on the first little debate there is. I forgot already what all the subjects are. It's a very, very packed. But it seems that they want to add meetings and debates more and more every year. So yeah, it's going
called
to be
forward
jam-packed.
guidance.
Right.
Yeah, exactly.
Yeah, just coming back, I think we can look, because it's already the time, we can look at a couple of currencies perhaps. Yeah, you highlighted the Aussie. It's an interesting one. It's actually pretty funny that Kiwi has lost more than the Aussie, and I don't see too much of a reason for that. If I can straight away reply to Ali about his euro dollar trade, I think it's we're in the middle of the range, Ali, and we are going to have to wait for data, going to have to wait for whether it be US data or Lagarde also to really take us out of the range. I really do not have myself an opinion about what your actual position is right now. I mean, 109.5 is spot in the middle of where we have been trading. So I really don't know. The only thing, as I said, that I noted was Aussie dollar, Kiwi dollar coming off, and dollar yen coming up a little bit. The dollar yen may be a bit of a double effect between the expectations of the Bank of Japan and then adding what Lane and Bostich were saying. So as well, dollar yen as yen crosses are trading a bit higher.
Yeah, we've had Nikkei making new highs as well.
Nikkei making new highs. People still, well, I mean, that's, I reckon, besides what Buffett may have done or initiated over a year ago, it's probably still also the fact that the market is well, first of all, looking at the other equity markets, which are trading at pretty high levels, but also probably thinking now that that Bank of Japan is going to be a slow one, and people are buying Nikkei on the back of it.
Yeah, exactly.
So,
Khalid, yes, there is going to be a F.A.C.E today. I think Dale's out. There's no interview.
yeah.
We'll be there. Keep Blake company on that one. So yeah, probably a half a face show, shall we say, half a face today for that one. Yeah, I've got a few fishing rods out. I actually only managed Friday to do my first new trade of 2024, a little scalp in the S&P, which I've still got a bit of a gut feeling, and this is only a gut feeling. Well, it was a bit of a gut feeling, bit of a price action feeling that we're potentially going to blow this 4,800 area. So I've got some buy stops in just above those prior highs just to potentially catch a break if one happens. I was inclined to buy a dip last week, which I didn't bother doing for all those earnings and everything. But I did manage to get in a little bit of a long just as the bank earnings were coming in not so bad, which I managed to run a few bits off, and then I just closed up for the weekend. So yeah, I've got a fishing rod in that one. I've still got a fishing rod out in dollar MEX, just to try and play the support down here. I was looking for a move in that move to get down to my buy levels down towards 1671. Never got there. So this area needs to be looked at closely because it failed where I expected it to run into trouble, and now we're coming back down again. So I'm still, as I say, got my fishing rod out there just to see if I can do some squigglings. I'm not quite as good as Blake at doing this. What I don't want to, or what I would rather see, is something like that. What I don't want to see is something like that, because that would be price action that suggests we're probably going to get a break. So I want to see a similar move to what we got there, and I see that again. So look at me doing me scribblings. Let's give it all those again. So that's another fishing rod I've still got in dollar MEX. I've taken down the size of the position a bit just because we had that failure there, and it keeps this trend ongoing. Aside from that, I'm just managing what I got. Still short dollar China. I thought that keeping rates on hold yesterday might have been a bit of a signal that they're not ready to go blood and thunder easing just yet. I thought that might have seen the one gaining some and this one dipping, but we're still holding this 720 area. Above 720, I'm going to probably reassess the trade. Think about taking majority of the table and just leave a little bit on for interest, because I still feel my trade is against the fundamentals at the moment. But as we know, they're still fighting it, still keeping the fixes in the 710s. So they're still not ready to let it go just yet. Other than that, I'm still long euro dollar and long euro sterling, which are not doing an awful lot right now. So I hope you got, what did you do with you're still holding your euro sterling short, Ali? I wondered what you were doing with that last week. And you as well, right, aren't you?
I am, but I'm if you can go onto the euro sterling there, I'm not going to be a hero if ever we start to get back above call it 2030 on those data. I'm going to be a bit data dependent, so that replies to Ali's question. Yeah, I'm still short. I think if the UK data continue to defy the laws of gravity, I would think that sooner or later sterling is going to do a last little bit of a leg up. But my position is nowhere near full steam either.
Yeah.
I'm a little nervous about what the market could think if numbers are starting to show the slowdown, because the market has been relatively positive. If you look where cable is, euro sterling is trading, sterling yen is trading, for instance, sterling on the crosses are trading. I need this confirmation below 87. Yeah, if you look at those crosses, they've been coming back relatively easily. So the market is still relatively positive towards sterling, and those numbers, that's why I'm saying I'm going to focus on the numbers this week, is really going to have to show us whether it's still justified to hold sterling or not,
Yeah.
And I won't be a hero if we start to get back above 86, even not your blue line there, but that those prior lows or those prior highs, 86, 20, 30, if it goes through there, I'll probably be gone. My average is all right without being ecstatic. But if we can get through 70, 80 on 85, 70, 80, then I think we're in for a retest of lower 85s. That's how I'm going to play this one.
Yeah. We were saying about the UK. I said it last week, and I know we were both saying it the week before. When the UK has positive sentiment, it's great, but it's got to be backed up afterwards by the data. And if it doesn't, if the data comes out all negative, then the UK is going to get hit, because then all the market bears come out and the told you so's, and the UK is going to disappear up its own butt, and all that sort of negativity starts coming out again. And then you find 1 minute cable's the darling of the currency world, and the next minute it's the devil, when everyone wants to sell the crap out of it, and you can't get a dip for love nor money.
No, that's exactly it. It's a sentiment trade. Sterling gets loved or hated, and there you can find serious moves. Then it's a bit of somewhere you can call it a bit of an emotional trade, the sterling. At times, when the market turns, it's probably going to go hard. But if the positive sentiment continues, then also it's been supported by where cable is holding all the time. That last week 126.10 was a decent level, held it and bounced from it. So that was a good indication as well that the market is still finding positives in the sterling trade.
Yeah, very much so. Just to answer Ali as well. Yeah, there's probably the longest I've gone in a new year without trading. I don't trade a lot. I don't trade 50 trades a day. That's just not my style. I have my levels and I wait for my levels. So I've had a few fishing rods out, as I've said, and they just didn't get triggered. Such is life. But I'm not a frequency trader at all. I like to pick my edges and stick to my edges if you know what I mean. But the first one to the belt was a profitable one, and that's the main thing. It's one thing, little superstitious thing I like doing at the beginning of the year, but making sure the first trade's a winning trade. But yeah, I'm not a high frequency. I'm not an HFT, Ali, unfortunately. Kay, is there anything you want to look at specifically, or do you want to call it a day for today? And we'll pick it up tomorrow.
I'm just call it a day, mate. I'm in a bit of a short-term euro yen long because it held those mid 158s where I saw a bit of support. Also, the daily cloud support down there. But I'm not looking for huge moves. And then I've got my longer term stuff on still silver, still patient to wait for lower levels if seen, if we get a little bit of a setback. My longer term dollar Swiss longs, but they are via options, I'm just looking for a move over time. For the Swiss to start weakening again, somewhere into the 87s, 88s for a starter, and then see what's happening there. And that's basically it.
More of a patience trade than euro.
Oh, very much so. Yeah, but the thing is, the good thing with options is that I've got okay, I'll tell the people what I have. I have a 3 months 85.5, and I have a 6 months 87 call. And I did them on the one day before last of last year, where Swiss was really getting bought massively when dollar Swiss was in the 83s, and I've already seen my 85.5 a couple of times, so I could trade off it. I'm trading my hedges around just to reduce the premium, and on the 85.5, my premium is already more than half paid back. So that's slowly getting to be actually a free trade now. So if it goes up, it's all beneficial, and that is even before the SNB officially starts to turn, which I think that they may do, perhaps in not too many words, but and on the other hand, the market may need to reprice a bit expectations for rate cuts elsewhere, and that should then put stuff like dollar Swiss a bit higher. Yeah, but that's why I did it. It wasn't expensive, and that's a bit of a more medium-term view then.
Yeah, and good luck with that one. I know there's a few people looking for the same type of moves. Right, well, we shall leave it there for today. So I hope you have a great week ahead. Hope we've got you nice and set up for the week ahead, so you know what's coming, and so there's no surprises to happen, except for the ones we don't know about. Have a great week's trading, everybody. Thank you very much, K-Man, as usual, and we shall see you all tomorrow. Have a good one.
Have a good week.